Hey guys, and welcome to this week's video. We're covering everything capital gains tax. So, if you've got an investment property, you have some shares, no matter how big or how small, this is a video you should watch. So, let's do it. Hey guys, and welcome to this week's video. We're talking about everything capital gains tax, often known as CGT. So, get ready, let's do it. Okay, we're going to do a few things. We're going to talk about some examples on shares and property when it comes to capital gains tax, but I thought the best thing we could do first up is to go through some basic understanding of some basic terminology that you should understand before we get right into our examples. So, the first thing is a little bit of a history lesson here for you guys. Capital gains tax came in 1985, the exact date being the 20th of September 1985. I probably would have been about this small and probably around about I think at that point I was just a few years from turning, a few months from turning 4. But, okay, so from that date, 1985, being 20th September, capital gains tax came in, which basically meant that after that date, if you had bought a property and it was purely for an investment or could be some shares, that when you go and sell it, whatever money you made on that investment would be taxed in the name of whoever owned it. Okay, if you owned an asset before 1985, well, and we're talking about investment property, right, or investment stocks, if you owned it before 1985 and you sold it, there'd be no tax. So even when we look at this date as well, if you had bought an investment before 1985 and you'd sold it today, all those years later, there will be no tax on it. So that's really good news. Probably one thing to talk about as well, when we're talking about capital gains tax, your family home, which is also known as your primary residence, in most cases, 99% of the time, is not going to be subject to capital gains tax. So don't go stressing thinking, oh no, when I sell my home, there's going to be tax. Don't worry, there's no tax on it. The next thing I think which is really important to identify is the contract date. What is the difference between the contract date and another one that we haven't put up there, the settlement date? Contract date, sometimes also referred to as the exchange date, but is essentially the date where you've decided to sell the asset. So when we say decide, I mean you've actually found a buyer. So if you were selling an investment property and you decide to sell it and you found that person after doing your marketing campaign with your real estate agent, when that person that's purchasing that property comes in and signs a contract and you sign the contract, you've then exchanged those contracts, and that is the date that we recognise that asset has been sold. Even though the reality is the settlement date, which might be 6 weeks later on average, is when you get your money. It's not the date we're concentrating on. So the date is when you exchange contracts, that contract date. When we look at calculating capital gains, the formula is basically looking at what you sold it for less the cost of the property. And when we're talking about cost, we refer to it as being the cost base. And cost base is made up of 2 areas, the first element and second element. The first element is pretty basic. It is, I guess, that what it cost you to purchase that property. So if we went back to my example with a $500,000 house, the first element would be just that pure $500,000. The other costs that might come into buying that property could be, say for example, the second element cost. So it could be legal fees on purchasing it. It could be maybe an agent representing you, like a buyer's agent. It could be the stamp duty when you purchase the property. These are all costs, second element costs, that have added to the entire cost of what it costs to make that transaction and own that property. Okay, the fourth thing I want to just mention, just so we have a clear understanding of some basic terminology, is capital proceeds. And capital proceeds is basically one day when you decide that you're going to sell that parcel of shares or that investment property, it's the total amount you get at the end of the day, I guess, once you've sold it. So it could be that, the $500,000 house you might have bought, way back. Now today you've sold it for $1 million, but in the process of selling it, you've had to pay an agent for marketing and then also a commission for selling it. There could also be other costs, say for example legal representation, so like a conveyancer. So what we would do is we'd take that $1 million sale, and whatever it costs to directly sell that property, we would take that off. So that could be, if it came to say $100,000 with all those costs, it means that the capital proceeds would actually be $900,000, because that's what you got once you sold it and you paid, I guess, those direct costs that you had to sell the property. The last thing I want to talk about is the CGT discount. It's 50% for individuals. And basically what that means is if with a CGT discount, if you have held that asset, whether it's shares or a property or whatever else it might be, for longer than 12 months, the good news is that whatever the capital proceeds less the cost base, whatever that amount is, only half of it's taxable. So we basically halve it, and we apply a 50% discount, and then we pay tax on that amount of money. Probably some things to note as well if it comes to the CGT discount is that if you hold an investment property or shares or any sort of asset that's subject to capital gains tax in a company, there is no discount. So if you hold it in the company, there's no discount that applies. Maybe the other thing to also consider is if you're a foreign resident. So you're not seen as a resident here for tax purposes in Australia. That would also mean that when you go and sell that asset, if you're a foreign resident, that there will be no discount on selling that either. So there's some really clear CGT basics that I think you need to know. So when we're going through some examples on how to calculate capital gains tax, you kind of get what we're doing. So let's just flip to the next page. So the first one we're going to talk about is shares, okay? And Maxwell Smart here, he bought shares in XYZ company. This is a company I've just made up with some data here. So Maxwell on the 10th of September 1985, and just a bit of a hint, this is pre-CGT, so this is before the capital gains tax came in, okay? He bought 1,000 shares and it cost him at $2.50, $2,500. Sometime later, in October 1992 there, he bought another 1,000 shares, and you can see the stock price has gone up to $5 a share now, and that cost him $5,000. And then a little bit time later, he hasn't bought any more shares, but he's obviously seen that Maxwell, being the smart guy that he is, has seen that XYZ is really shooting off. It's a great company to purchase and own. So he's gone a little bit harder, and he's purchased 2,000 shares, and they were $10 a share then, and it cost him $20,000. Now, what he's done as well is he's realised that, I guess, he's done all he wants to do with them, and they're not going to go up any higher, and he wants to sell out. Whatever his reasoning why was to sell, but Maxwell decided to sell the shares. And he sold them here on the 29th of June 2021. Now, the other thing to note as well, that he sold them for $40 a share, and he's received $160,000 of proceeds from the sale of those shares. Probably one thing to note is when I'm going through these examples here, normally a stockbroker, whether it's a full-service broker or an online platform, they will charge a brokerage fee. For the simplicity of today's example, I've actually said, let's not worry about brokerage fees. But for our example here, the 29th of the 6th, he's actually went into a contract to sell those shares, and on the 5th of July 2021, he received his $160,000. Happy days. So, probably another hint, there's probably two hints that we're taking off this page here. Pre-CGT, so we're going to ignore that. The other thing as well is think about that contract date we were talking about before. Okay? So, whilst I'm turning over the page, so he's sold those shares on the 29th of June, and that's contract date. Now, you know that the 30th of June is when our financial year ends, and goes into the next financial year. So, should the sale of the shares go in this financial year, the year we're in now, being the 2022 financial year, or should it go in the 2021 financial year? Well, the answer is because he went into a contract to sell them on the 29th of June, which is in the 2021 financial year, the capital gain will fall in that financial year. So, here we've got the shares cost in total $27,500. He sold the shares for $160,000, so the profit he's made over time has been $132,500. But remember, that first parcel of shares he bought at $2.50 is going to be exempt from our calculations. He doesn't have to pay any tax on the money he's made on that, right? So, effectively, how are we going to do that? Well, all we're going to concentrate is on those parcel of shares that he purchased after the 20th of September 1985. And there was two parcels. There was one that had 1,000 shares there at 5,000, and then the second parcel after that date was 2,000 shares for $20,000. So the total cost there was $25,000 for those shares. Now, effectively, he did sell 4,000 shares, but only 3,000 of the shares were after that CGT date of the 20th of September 1985. So, therefore, what we're going to do is we're going to actually only concentrate on the parcel shares. So we're going to take a pro rata of 3,000 over 4,000 shares times 160,000. So the only amount that's actually going to be taxable capital proceeds is going to be $120,000. So when we talk about capital proceeds, we're only interested in what is going to be taxable. So only $120,000. So to work out what that capital gains tax is going to be, let's work out what the capital proceeds is going to be. So we're going to have capital proceeds less our cost base. So we had $120,000 less $25,000. The net gain is $95,000. Now the good news is Maxwell, being the smart guy that he is, has only owned the shares, or has owned the shares for more than 12 months, which is great. So there's two great things going on here for him. He had those pre-85 shares, which don't have any tax on them. The second thing is he's held it for more than 12 months, which basically means as well is that he is now eligible to discount that net gain by half. So we're going to take off $47,500, and that means that $47,500 is left over, and that is taxable. Now, people always say to me, well, how much tax do I need to pay on that capital gain now? Well, it's all relative to how much you're earning in your other day-to-day job, and we call that your marginal tax bracket. But if let's assume that the worst case scenario, it's always best to assume the worst case before we calculate your tax, and we'll say that let's go for the highest marginal tax rate of 47%, being on the $47,500 would be $23,000, just over $22,000 basically. Okay, so what I always tell my clients is what we'll do is we'll work out the capital gain. Let's just work it out in the worst case scenario. Keep $22,000 aside for when it comes to tax, and then we do your tax return. If there's any money left over, hey, good for you. We'll leave that for any other activities. Do what you want with it. But at least this way, until we've lodged your tax return and prepared it, we can leave that money aside so you don't get caught up. You know, if you spent the whole proceeds of what you'd made and you didn't have any money left, well then you'd have a tax issue. You wouldn't be able to pay your tax liability, and we don't want to be on the wrong side of the ATO. So that is our shares example. So, okay, well, the next part is now looking at property, and property is a little bit the same, but a little bit different at the same time as well. So in this example here, we have a property CGT example, and they've bought a unit for $300,000. And remember we talked about that first and second element. That is going to be your first element. The second element was there was two parts to it, and there's probably usually a lot more than this, right? But generally speaking, there's always stamp duty and always legal fees. And the stamp duty on the $300,000 unit was $25,000, and the legal fees that they paid their conveyancer or their solicitor was $2,000. So what did it cost to go and acquire that property? Well, we'll add up the $300,000 being the first element, and our second element total being $327,000. So that's what it cost to buy the property. Now, let's just pretend this is still Maxwell. I didn't give a name for this example here, but really smart guy, and he's decided that within less than 12 months, he is going to sell the property because the property market has just shot up and he wants to make a quick gain on it, which happens quite often as well. So he's exchanged the contract on the 5th of the 7th, 2021, as I said, held for less than 12 months. So the bad news is here that there's no discount on that capital gain. So if he held on just for a little bit longer, up to that 12 months when he purchased it, there would be a 50% discount on whatever money he made. But I guess the other thing as well is he wanted to take that money now. The risk could be that the market could plummet and he might not make that money. But nonetheless, this is what he's decided to do. So he sold the unit for $400,000, which is, we said that he purchased it for $300,000, so that is a clear profit of $100,000. But in order to sell it, there was some costs that he did have to incur to sell that unit. And he had to pay a real estate agent some marketing fees, which was $2,000. And let me assure you that you don't think you're going to find any marketing for $2,000. It's probably more likely should be $10,000, but nonetheless. And then he paid his agent 2% commission, being $8,000, and then some legal fees again just for the conveyancer. So the total cost to go and sell that property was $12,000, which means that the net capital proceeds that is left is $388,000. Okay, so we can quite clearly see here that there is he's made a little bit of money. So what is that net capital gain? Well, we take those capital proceeds, which we just calculated at $388,000, and we minus that cost base being $327,000. And remember, normally this is where we would go, well, this is the net gain, and we'll apply a discount. But because they held it for less than 12 months, there's no discount on that property, on that capital gain. So we're left with $61,000. And once again, if we take that worst case scenario, being the highest marginal tax bracket, which is 45% plus 2% Medicare levy, which comes to 47%, is $28,670. So that is the tax that is paid on that one. So that happens to be everything that I've got there. If you've got any questions about capital gains tax, I invite you to give us a call and get in touch with us. You can find us on ngraccounting.com.au. We hope that you connect with us and reach out to us and let us help you calculate your capital gains tax. Okay guys, have a great day and thanks for watching. Don't forget to subscribe and like this video if you feel as though it's been really informative.